Welcome back. In this video, we continue our discussion on business combinations. In this video, we'll be learning about the consolidation procedures, particularly the preparation of eliminating entries. As discussed previously, a parent is required to consolidate its financial statements and the financial statements of its subsidiaries on the date of acquisition and every reporting period thereafter. However, a parent is exempted from preparing consolidated financial statements if it meets the following criteria. The parent is itself a wholly owned subsidiary or is a partially owned subsidiary of another entity, and its other owners, including those not otherwise entitled to vote, have been informed about and do not object to the parent not presenting consolidated financial statements. Its debt or equity instruments are not publicly traded. It is not in the process of issuing securities in public securities markets, and the ultimate or intermediate parent publishes consolidated financial statements that comply with Philippine financial reporting standards. To emphasize, when a parent is exempted from preparing consolidated financial statements, it is the ultimate or intermediate parent, or the parent of the parent, that prepares the consolidated financial statements. Here is an overview of the consolidation process. First, we need to combine like items of assets, liabilities, equity, income, expenses, and cash flows of the parent with those of its subsidiaries. For example, cash of the parent plus cash of the subsidiary equals consolidated cash. Or AR of the parent plus AR of the subsidiary equals consolidated AR. We also need to offset or eliminate the carrying amount of the parent's investment in each subsidiary and the parent's portion of equity of each subsidiary. Recall that in a stock acquisition, the parent records the investment as debit investment in subsidiary, credit consideration transferred. In the separate financial statements of the parent, the investment in subsidiary account is included in total assets. If we do not eliminate investment in subsidiary, then we're basically double counting the subsidiary. Hence, the investment account needs to be eliminated. Similarly, the parent's portion of equity of each subsidiary should also be eliminated. This is in relation to the recognition of goodwill or gain on bargain purchase. Lastly, we need to eliminate in full intra-group assets and liabilities, equity, income, expenses, and cash flows relating to transactions between entities of the group. Recall that in consolidation, the parent and its subsidiaries are considered to be just one economic entity, and therefore, intra-group or intercompany transactions should not be counted and should be eliminated. As discussed previously, the parent is required to consolidate on the date of acquisition and on every reporting period thereafter. As part of the consolidation process, the parent prepares eliminating entries in the working papers. To emphasize, eliminating entries can only be found in the working papers. They cannot be found in the books of the parent nor the subsidiaries. They also do not affect the separate financial statements of the parent nor the subsidiaries. On the date of acquisition, the parent prepares two eliminating entries. The first eliminating entry has three objectives. First is to eliminate the subsidiary stockholders' equity. Second is to partially eliminate the parent's investment in subsidiary account. And third is to partially establish non-controlling interest. The amounts credited to the investment in subsidiary account and to the non-controlling interest account are in proportion to the parent's interest and to the non-controlling interest. For example, let's say that the total stockholders' equity of the subsidiary is 100, and the parent's interest is 80%, while the NCI is 20%. The amount credited to the investment in subsidiary account is 80. That's 100 times 80%. And the amount credited to the non-controlling interest is 20. That's 100 times 20%. The second eliminating entry has 4 objectives. The first objective is to restate the assets and liabilities of the subsidiary from book value to fair value. Understated assets are debited, while overstated assets are credited. Understated liabilities are credited, while overstated liabilities are debited. The second objective is to recognize goodwill or gain on bargain purchase, which we have already learned to compute in previous videos. The third objective is to completely eliminate the parent's investment in subsidiary account. And the fourth objective is to completely establish the non-controlling interest. Again, the amounts credited to the investment in subsidiary account and non-controlling interest account are in proportion to the parent's interest and the non-controlling interest. To summarize, these 2 eliminating entries have the following effects on the consolidated balance sheet on the date of acquisition. First, the subsidiary's equity accounts are eliminated. Second, the subsidiary's assets and liabilities are restated to fair value. Third, goodwill or gain on bargain purchase is recognized. Recall that under stock acquisition, goodwill or gain on bargain purchase are not recognized separately in the parent's books. Hence, under stock acquisition, we can only find goodwill or gain on bargain purchase in the consolidated balance sheet. Fourth, investment in subsidiary account is eliminated. And lastly, fifth, NCI is recognized. NCI can only be found in the consolidated balance sheet, not in the separate books of the parent nor the subsidiaries. On the first year of acquisition, the parent, assuming that it is accounting for the investment in subsidiary using the cost method, prepares the following eliminating entries. The first 2 eliminating entries are exactly the same as the eliminating entries prepared on the date of acquisition. This is because these 2 eliminating entries did not affect the separate financial statements of the parent and the subsidiaries when they were first made on the date of acquisition. Hence, every time the parent has to consolidate, the parent needs to repeat these 2 eliminating entries. The third eliminating entries pertains to the undervaluation or overvaluation of the subsidiary's assets and liabilities on the date of acquisition. Undervalued inventories on the date of acquisition results in understated COGS when these inventories are sold. So to correct, we debit COGS credit inventory. On the other hand, overvalued inventory results in overstated COGS. So to correct, we debit inventory credit COGS. Undervalued depreciable PPE results in understated depreciation expense. So to correct, we debit depreciation expense credit accumulated depreciation. On the other hand, overvalued depreciable PPE results in overstated depreciation expense. To correct, we debit accumulated depreciation credit depreciation expense. Undervalued or overvalued non-depreciable PPE only affects the subsidiary's net income when they are sold. So adjustments for these assets are made only when they are sold. To continue, overvalued liabilities implies that there is a discount, and the amortization of a discount increases interest expense. Hence, interest expense is understated. To correct, debit interest expense, credit discount on bonds or notes payable. On the other hand, undervalued liabilities implies that there is a premium, and amortization of premium decreases interest expense. Hence, interest expense is overstated. To correct, we debit discount on bonds or notes payable and credit interest expense. The fourth eliminating entry on the first year of acquisition pertains to dividends paid by the subsidiary. Recall that under the cost method, the parent recognizes dividends paid by the subsidiary as dividend income. Recall as well that upon consolidation, the parent and its subsidiaries are considered to be just one economic entity, and therefore, dividends between the subsidiaries and the parent should not be recognized. So, to reverse the dividend income recorded by the parent, we debit dividend income. And to cancel the dividends paid by the subsidiary, we credit dividends paid. The credit to dividends paid is an adjustment to the subsidiary's statement of retained earnings. We also debit non-controlling interest for the NCI's share in the subsidiary's dividends. Let's say that the total dividends paid by the subsidiary is 100, and the parent's interest is 80%, while the NCI is 20%. Of the 100 dividends paid by the subsidiary, 80 is paid to the parent and 20 is paid to NCI. The share of the NCI in the subsidiary's dividends is debited to NCI because this is recognized as a return of investment. And considering that NCI has a normal credit balance being an equity account, dividends paid by the subsidiary to the NCI results in a decrease in the balance of the NCI. The fifth eliminating entry pertains to the non-controlling interest share in the subsidiary's adjusted net income. We debit non-controlling interest in net income of subsidiary to separate the NCI's share of the net income of the subsidiary from the parent, and we credit non-controlling interest. Again, since non-controlling interest or NCI is an equity account, the share of the NCI in the subsidiary's net income has a result of increasing the NCI's balance. Let's now proceed to the second year of acquisition, or the year subsequent to year of acquisition. Assuming that the parent uses cost method to account for investment in subsidiary, the first eliminating entry to be prepared on the second year is referred to as the reciprocity entry. This entry has the objective to convert cost method to equity method or to establish reciprocity at the beginning of the year. The amount recorded in this entry is computed as follows. First, we take the retained earnings beginning balance of the current year and compare it against the retained earnings balance on the date of acquisition. Take note that for the first amount, we should use beginning balance, not ending balance. And for the second amount, we should use the balance of the retained earnings on the date of acquisition. The difference between these two amounts multiplied by the parent's interest is the amount recorded in the reciprocity entry. Why do we need to prepare this entry? The answer relates to eliminating entry 2. If this eliminating entry seems familiar to you, that is because this entry is almost the exact same entry that we prepared on the date of acquisition and on the first year of acquisition. Recall that this entry has 3 objectives. First is to eliminate the subsidiary's stockholders' equity. Second is to partially eliminate investment in subsidiary. And third is to partially establish non-controlling interest. Recall that under the cost method, the investment in subsidiary account remains the same or remains at cost from one period to another unless impaired. That's why it's called cost method, because the investment account remains at cost. It does not move from one period to another. On the other hand, the retained earnings of the subsidiary is likely to have increased since the date of acquisition due to net income. Now, without the reciprocity entry, and if we just have eliminating entry 2, the investment in subsidiary account would have resulted in a negative balance. Hence, to prevent that, we need to prepare the reciprocity entry that includes a debit in the investment in subsidiary account. Again, that is to prevent the investment in subsidiary account being negative after we have made the second eliminating entry. Let's now proceed to the third eliminating entry. This entry is exactly the same as the second eliminating entry prepared on the date of acquisition and on the first year of acquisition. Recall that this entry has 4 objectives. First is to restate the subsidiary's assets and liabilities from book value to fair value. Second is to establish goodwill or gain on bargain purchase. Third is to completely eliminate investment in subsidiary. And fourth is to completely establish non-controlling interest. Why do we need to prepare this entry again? Recall that eliminating entries do not affect the separate books of the parent nor the subsidiaries. So when we prepared this exact same entry on the date of acquisition and on the first year of acquisition, afterwards, the separate books of the parent and the subsidiary remained the same. Again, the eliminating entries did not affect the separate books. For instance, the subsidiary's assets and liabilities are still recorded at book value in the subsidiary's separate books. Hence, every time the parent has to consolidate, the parent needs to restate the subsidiary's assets and liabilities from book value to fair value. Similarly, in the separate books of the parent, the investment in subsidiary account still exists. And so every time the parent has to consolidate, the parent needs to eliminate investment in subsidiary. Moreover, every time the parent has to consolidate, the parent needs to establish goodwill and NCI because these cannot be found in the separate books of the parent nor the subsidiaries. These can only be found in the consolidated balance sheet. The fourth eliminating entry pertains to adjustments to the subsidiary's net income due to the under and overvaluation of the subsidiary's assets and liabilities on the date of acquisition. This entry is similar to the third eliminating entry prepared on the first year of acquisition, except that this entry reflects the cumulative adjustment to the subsidiary's net income. Cumulative because, again, the eliminating entries prepared in the previous years did not actually affect the separate books of the subsidiary. Recall that on the first year of acquisition, we prepared this eliminating entry to adjust the subsidiary's net income for the under and overvaluation of the subsidiary's assets and liabilities. The net adjustment of this entry is reflected in this eliminating entry as debit to retained earnings. Hence, the amount debited to retained earnings in this entry reflects prior year's adjustments to the subsidiary's net income. This entry consists of income statement accounts and balance sheet accounts. The income statement accounts, such as cost of goods sold, depreciation expense, and interest expense, reflects the current year's adjustments to the subsidiary's net income. On the other hand, the balance sheet accounts, such as accumulated depreciation and discount on bonds or notes payable, reflects the cumulative adjustments to the subsidiary's net income, including prior years and the current year. For instance, accumulated depreciation, this being the second year, reflects 2 years' worth of adjustments. Similarly, discount on bonds or notes payable, this being the second year, also reflects 2 years of adjustments to the subsidiary's net income. The fifth and sixth eliminating entries on the second year of acquisition are similar to the eliminating entries prepared on the first year of acquisition. The objective of the fifth eliminating entry is to eliminate intercompany dividends and to decrease non-controlling interest for its share of dividends. The objective of the sixth eliminating entry is to establish non-controlling interest in subsidiaries' adjusted net income. In the next video, we'll proceed to discuss the eliminating entries for intercompany transactions.